And in a growth market, it's nearly impossible for a company to kind of maintain such dominance as Tesla has.
All of the markets, the stock market, cryptocurrency market, real estate market, even Pokémon cards, are teetering at all-time highs. However, the actual market is dealing with inflationary pressures that are 30 years high, persistent supply chain issues, and a manner of life that is still very much influenced by COVID-19 regulations. Various people have different perspectives on the disparity. Investors, on the other hand, raise caution flags when they see businesses like Lucid Group and Rivian Automotive valued at a combined whopping $200 billion. Why Lucid and Rivian might be an indication of a market peak, how to approach those two firms, and what to do if you're concerned about a market decline are all discussed in today's video. So, take a seat, relax, and jot down some notes. Welcome back to New Vehicle Media, your go-to channel for EV stock. Quick reminder that subscribing is free and liking the video helps YouTube suggest similar content. Comments are loved and featured in our upcoming videos. The electric vehicle business is one of the most publicized segments of the entire market. In the light of the valuations, it seems that EV stocks are valued based on their growth potential as well as the chance that they may emerge as difference makers in the automotive sector. Cryptocurrencies, non-financial technology companies, and SPACs have ushered in a period of speculation in which investors are ready to disregard fundamentals in favor of the speculative potential of these instruments. There is no doubt that the electric car industry has been driven ahead by this speculative surge, even if few people would argue that it's not. It is significantly less spectacular when it comes to traditional automobile manufacturers. With a market capitalization of $258 billion and ranking first in the car sector based on manufacturing, Toyota is now trading at a low price-to-earnings ratio of just 5. Volkswagen, the second largest manufacturing car maker in the world with a market cap of $132 billion, has the same multiple ratio. A total of more than 20 million automobiles are produced by the two traditional automakers every year. During the year 2020, Tesla only delivered 500,000 EVs. Towards the conclusion of the third quarter, the firm had reached an annual run rate of 1 million electric vehicles per year in 2021. Even yet, it is far less than those of the traditional automobile manufacturers. In the case of production in 2020, Tesla's stock is valued at an incredible $2.2 million per vehicle produced, or $1.1 million per car produced if the most current manufacturing run rate is used. Toyota, on the other hand, is only worth $24,800 of every car manufactured, while Volkswagen is only worth $12,800 for each vehicle sold. This shows something about the EV bubble in the EV sector. With its $11.9 billion IPO, Rivian, a manufacturer of electric pickup vehicles, became the year's largest IPO. The stock started 37% higher than its IPO offering price, boosting its market capitalization to more than $90 billion. Incredibly, Rivian has a bigger market cap than electric vehicle manufacturers Lucid and NIO, because investors believe that the transition away from internal combustion engines would result in significant revenue growth. Those firms have been at the center of some of the most significant stock market changes lately. For the time being, however, all of the EV startups, with the exception of Tesla, are unprofitable. First half losses for Rivian, Nikola Corp, Lordstown Motors Corp, and Lucid are in billions of dollars. If there was ever a hint that the market had reached its zenith, witnessing Rivian soar to a market cap of more than $150 billion at its apex is most likely it. More seasoned investors may recall, with remorse, the dot-com bubble of 2000 to 2002, during which IT businesses with little to no revenue were valued in the billions of dollars for nothing more than a marketing strategy. Rivian hasn't even begun shipping its cars yet, and yet the company has already surpassed every EV manufacturer apart from Tesla and became the second most valued car maker in the United States. Lucid, on the other hand, has a market capitalization of about $90 billion. When you consider that the firm is manufacturing and shipping vehicles and that it has 6 of the top range ratings of any EVs evaluated by the U.S. Environmental Protection Agency, the situation seems a bit more reasonable. It also sells high-performance variants of its Lucid Air luxury car, which can produce more than 1,000 horsepower. The luxury automaker also has some extremely remarkable technologies that can compete with Tesla on a level playing field. Even Lucid, with all these achievements, seems to be becoming more pricey as its stock price diverges from the fundamentals. While the stock prices of Rivian Automotive and Lucid Group have fallen in recent days, the company's stock prices have risen significantly over the previous week as investors welcome the company's entry into the electric car market. Both businesses are brimming with promise, but they are a long way from being profitable. As with the dot-com boom of the late 90s, the dot-com bubble was fueled by unrealistic expectations. At the time, investors continued to pour money into overvalued internet stock prices for years, taking advantage of the new technology's rapid adoption at the time. The Nasdaq was valued at 200 times its earnings as a result of the hysteria. It's difficult not to worry whether something similar may happen to the electric vehicle industry right now. It is very conceivable that numerous electric vehicle firms may be successful in the future, but that does not imply that their stock prices will continue to rise indefinitely. Because Qualcomm and Cisco were able to endure and eventually grow during the dot-com bubble, investors were left with negative feelings about the companies. It took decades for the promise to be realized, and the momentum traders who flocked to their stocks during the dot-com period were annihilated. They were correct in terms of what the future will look like, but they were very much overly optimistic in terms of when it would happen. Ultimately, the most effective method to approach a market peak is to invest in firms that you understand, are interested in, and will remain with through thick and thin. If you're looking to make a fast profit, investing in growth companies such as the EV industry is usually not a good option. However, if you believe in the business and are ready to wait for the investment thesis to play out as well as to stomach the volatility, it might be a wise decision. However, for the vast majority of investors, investing in firms that are market leaders with a gradual and steady growth trajectory is generally the best strategy. I am very interested in hearing your thoughts on this specific issue. Without a doubt, the electric vehicle sector deserves all of the praise it receives as it's the next big thing in the transitioning world. But do you believe we are on the verge of seeing yet another market crash? Or does the sector have the capabilities to live up to its standards? Let us know what you think by leaving a comment down below. Robert Anderson believes that Apple has sufficient muscle and financial power, and as a result, the company does not need a partner. Apple has the ability to employ an almost limitless number of talented individuals and engineers. If they do decide to partner up, it will be purely out of convenience for them. That should wrap things up for today. Keep in mind that subscribing is still free, and liking helps YouTube recognize your preferences. Thanks for taking the time to watch, and I look forward to seeing you in the next one.